Good morning, everybody. This is Greg Gossett, and today is Saturday, December 3rd, 2022, and you have come to another edition of the Gossett Trading and Mentoring Weekend Review. In this review, we are going to talk about all the trades that I took last week, the daily time frames, weekly time frames, monthly time frames. We're going to look at all the trades I have, talk about when I entered them, why I entered them, and most importantly, how I am going to manage them going forward. So hope you're doing well. We had a big week last week in the market. Boy, it seemed like the market was never going to rally there, but we have had a nice little rally off of the bottom, and I hope you've been able to participate in this. And we've had some really good trades over here on my end, and excited to show you those trades as well. So here's the format. Like I said, first of all, we're going to take a look at all the trades that I entered and how I'm going to manage them going forward. After that, we are going to talk a little bit about trader psychology. Always the most important part of trading, the most important skill in trading is the ability to create a plan and follow the plan that you created. Always like to talk about that. It really is a skill, everyone. Everyone talks about, hey, how do you enter? And that's the main thing. Where are the entries at? But how you manage the trades, and if you manage the trades according to your process, that's really at the end of the day what's going to make you a profitable long-term trader. So we'll touch on trader psychology. Then we're going to do a poem for my good friend Frank, who is a trading poet. Always like to throw one of those in. They're always good, always pertinent to what's going on in the market. And then after that, I have gone down through my entire master watch list, and I do have some potentials on the daily charts next week. Also have some weekly potentials, and then also have some short potentials both on the daily and weekly as well. So weekly trades are taken on Fridays, and because I only do this podcast on the weekend, I like to talk about it beforehand. Hey, if the weekly does this on Friday, then I'll enter the trade either to the downside or to the upside. And then, of course, the dailies, what I'm looking for next week. Now, we've had this big rally, and I found it difficult to find some good daily setups after this rally. I did find some, but I also do have some potential daily and weekly short positions that I will be looking at as well. All right, so we're going to go through the daily longs, the daily shorts, the weekly longs, and the weekly shorts, and I'll give you an idea of what I'm looking for, what the levels are that I am looking for. So that will be the podcast. And first of all, before we get started, let's run the U.S. legal disclaimer, and I'll be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All righty, well, let's get to it, and we'll start with the daily swing positions that I have. Okay, so it's been a while since I've had one of these particular kind of setups. I really love these setups. This is called a return to value with the V1 or a V2 entry trigger. And, the green lines here, this green line here is the first Keltner channel, first positive Keltner channel, and the green line below is the first negative one Keltner channel. Anywhere in between these green lines here is considered the value zone, or it's the mean. As we get to the 1, 2, and 3 ATR channels, or the negative 1, 2, and 3 ATR channels, these are 1 standard deviation from the mean, 2 standard deviations from the mean, 3 standard deviations from the mean. This is a positive 1 standard deviation, 2 and 3. And, this is kind of a simple concept, but I don't think a lot of people look at it this way. I studied one-on-one with Dr. Alexander Elder, and he really put this into my mind. He said, Greg, think about it. When you buy a stock, you want to buy it in value, and then you want to sell it above value, or you want to buy it below value and sell it in value. And what a lot of people do is when they see stocks moving up strongly like this, they tend to want to chase it. But not that it doesn't work sometimes, but more times than not, buying this momentum fails and the stock price wants to revert to the mean. So you'll rarely see me buy these kind of moves because I'm buying above value, right? Where ultimately I want to buy in value and I want to sell above value, or again, I want to buy a deep dip buy below value and most likely sell it back to value. And in this podcast, because we're it's only about an hour podcast. I do my best to explain these concepts and the rules, but it's probably just enough to get into trouble. And I think you need to be fully trained on a strategy, step by step, exactly how to do it. I have a lot of if-then rules. If this happens, then I do that. If that happens, then I do this. So I have a lot of rules. And so I don't have time in the podcast to go through all the nuances of everything. And so I'll discuss this at the end of the podcast. But if you are interested in learning how to trade like I do, the 5 different approaches that I use, I do teach private one-on-one lessons in the evening time via Skype. And the best way to learn anything is to learn one-on-one with your instructor, and that's why I offer this course. My email is in the link of this YouTube video below, and so if you are interested in doing the one-on-one lessons with me, please reach out, and I promise you, in these lessons, you will learn all the rules. Okay, so let's get back to it. So here's CarMax, KMX. Well, again, here's the 1 and the -1 ATR channel. In here is anywhere in here is the value zone. Well, did we go above value? We sure did. We certainly went above value. So I'm looking for a return to value, or in other words, a return to in between the value zone, which it has done. Now, just because it gets there, does that mean I automatically buy? No, I have to wait for the proper setup. But the first step in this is looking for a market that moves above value, then comes back to value. And then the key important part is that we have some sideways motion. So why is that sideways motion interesting or needed? Well, it shows that there's some stability there. It shows that there's an equal amount of buyers or sellers, that it has support. So once that happens, I need an entry trigger to get me involved in the trade. And an entry trigger that I use for this is either a V1 or a V2 entry trigger. Now, this is a V2 entry trigger, but there are also V1 entry triggers. And on my YouTube channel, in the lessons playlist, I have a free video that talks about a V1 and a V2 entry and the particulars of it. So anyway, I did go long on CarMax back here on the 29th of November with the V2, keeping in mind, move above value, return to value, sideways motion, and then my trigger was the V2 here. Basically, a V2 consists of 3 bars, bar 1, bar 2, and bar 3. Bar 2 goes below the low of bar 1 by at least a quarter ATR, and then bar 3 has to close above the close of bar 1. See how it creates this little V formation here? So that was my entry. My entry was at 66.79. Now, of course, I always place an emergency stop 2 ATRs below my entry, right? That's going to be my emergency stop. And what I do is I take, I always talk about position sizing based upon the current market volatility. Well, the 2 ATR does this all for you. It takes into account the movement of the bars and the volatility. So that's why, position sizing is so important. So what I do is, let's just take a hypothetical $25,000 account today. Okay, let's just say you have a $25,000 account. Well, I always take 1% of whatever my account is. If it's 100,000, it's $1,000. If it's 50,000, it's $500. If it's 25,000, it's 250, right? So in this case, let's use $25,000. 1%, 250. I would take whatever that number is, the 250. I would divide it by the value of the 2 ATR, divided by 6.33 in this case, and that would show me how many shares to buy. 39.49. So I just round it down to 39. So that tells me how many shares to buy. But then I place my emergency stop 2 ATRs or 2 standard deviations below my entry. And so if I do buy 39 shares here and it does move down 2 ATRs below my entry, well, then that's my emergency stop. I get out immediately. Usually I wait till the end of the day to make my buying and selling decisions, because the end of the day price is the most important and valid price of the day, in my opinion. But at some point you have to cry uncle, and if it does move 2 ATRs below, I go, okay, I was willing to risk 1% on my trade, and then I get out immediately. So I always have an emergency stop to begin with, but then I also have an end of day stop. Well, on a V2, an end of day stop is a close below halfway of the washout bar. So on a V2, it's the second bar. Bar 1, bar 2 that goes below, that washed out the low and then reversed. So from a Fibonacci standpoint, halfway of this washout bar here is my stop, but it has to be a close. So here I bought it at 66.79, right? And then the next day it opened and then went below my stop, but I have to wait till the end of the day to make my decision. But it recovered. It did test that halfway and it recovered, right? So had a nice trade on this. The very next day did hit a couple profit targets. I always take off a portion of my position whenever the market moves up the value of at least 0.45 from the previous day's close. So I took off, I believe I hit 2 profit targets on that day. And I always take 10% of my profits off, or 10% of my position off whenever I move 0.45 ATRs or 0.9 ATRs, right? I can hit 2, 3, 4. I think I've hit 7 before in a day. So I always like to play offense and defense. Defense are trailing stops, end of day stops, emergency stops. Offense is scaling out into strength. Now I have the orange line up here. What is this? This is my trailing stop level. Once I get to my trailing stop level, then I tighten up my stop so I don't give back all of my gains. But I like to see it move 1.5 ATRs. And you might say, why 1.5 instead of 1? Well, 1 is the average that it's expected. It doesn't mean anything. It's just considered noise. If it moves 1.5 ATRs, then it has gotten outside of noise. And so that's where I start my trailing stop levels at. So again, return to value, sideways motion, V2 entry, entered at 66.79, moved up, took some profits, has not got to my trailing stop level yet. My end of day stop still in place here. And so far, so good. This particular trade, let's see, roughly here from entry to current price, up 4.05%. Not too shabby. UUP. UUP is a new entry that I took last Friday. Why did I take this? Well, my students and people that follow this channel probably know. I discussed this last week. I said if UUP, which is the US dollar ETF, if it does get down to the 200-day moving average and bounce, I will buy it. And that's exactly what I did on Friday. I got in at 28.23. It's currently 28.23, so completely break even on the trade. Now, again, how did I enter the trade? I took my maximum allowed loss. I divided by the value of the 2 ATR. That told me how many shares to trade. I placed my emergency stop down here. Where's my end of day stop, would you think? That's right. It simply is a close below the 200. You know, emergency stops only get hit about 5% of the time. And the majority of the time, if you have a loss, it's just going to be an end of day stop, or in other words, a close below the 200-day moving average. But the key here, do I know it's going to go up? I absolutely do not know. Do I want it to? Of course, right? But why did I buy it here? Well, here's the 200-day moving average, 200 SMA. In general, I know that buyers will be interested in coming in at the 200-day because it gives them a very good line into the sand to give them a good risk to reward ratio. I also know shorts are most likely going to cover once we get down to the 200-day moving average. And I know that there will be probably an infusion of new buyers at the 200-day moving average. And so I have two groups of buyers coming in at this level. And that's why prices tend to get support at the 200-day moving average. It could just completely collapse on Monday and go down and hit my emergency stop, but that's part of trading, isn't it? So orange line up here, my 1.5 ATR trailing stop level. So it's very mechanical, and I think mechanical is good in trading. And so again, it bounced at the 200-day moving average, have my emergency stop 2 ATRs below. I have my end-of-day stop, any close below the 200 on any day that happens. Have my 1.5 ATR trailing stop level here. And if it gets there, then I will go into trailing stop mode. And this particular trade completely break even. Now, I did have some losing trades last week, all part of trading as well. And I did short silver here on the 25th of November when I had a lower high close below the 200-day moving average. Now, the next day, it worked in my favor. It went down nicely. I took off profits, as I mentioned earlier in the podcast. Whenever I have partial profits at a certain level, I will take them. And I did hit 2 profit targets to the downside, and I took 20% of my position off. Now, where is my end of day stop? Well, this is a short, so it's just completely opposite of the long. Any close above the 200-day moving average. Of course, you can see here is my emergency stop above, because if you're short, you have to place the emergency stop above. So it was a lower high rejection of the 200, shorted here at 1972. Next day went down, took some profits. Next day went up, but held the 200-day moving average. And then the next day, boom, I had to get out of the trade. You can see it did not get to my emergency stop level. Had it got there, I would have had to have gotten out immediately and hit my maximum allowed loss on the trade. But you can see the taking the partial profits to the downside helped mitigate the loss. And I had to get out here on that day for a loss of 3.43%. Then the next couple days, holy smokes, it's never fun to take a loss, but there is some kind of joy if you do take a loss, at least for me. If it keeps going, you're like, oh man, I am glad that I followed my process and followed my rules, because if I would have got stubborn with it, I would have been in a whole lot of hurt, because we just rallied strongly after that. So loss on SLV of 3.43%. All right, this is a good example. This happens a lot in trading, and so it's a good example for everyone to see. I did take Concert Pharmaceuticals with a higher low close back above the 200-day moving average, and place my emergency stop, place my trailing stop. My close on this particular position would have been any close below the 200. Held the 200 the next day. Next day had a big move up, took some profits. Excuse me. Took, I think I hit 2 profit targets, or possibly 3 on this day. I can't remember offhand, which was great because I like to take profits into strength. Next day, we got to my trailing stop level. So this is a good example here of I finally got to my trailing stop level. And what does that mean? Well, if I get to my trailing stop level and then I have a close below the previous bar's low after reaching the trailing stop level, I get out of half. And so I did get out of half for, let's do some quick math here, approximately 6% profit, which was great. But then I still had half left, and the half left, I wanted to give it some room to breathe because I had taken profits. I had taken half profits here on the way down, but my stop would have been just a close below the 200-day moving average, and that is what happened here on the 29th. And I did get out for a very small loss on the second half of the position of 0.84, but still a profitable trade nonetheless, because took profits into strength. Used my trailing stop level here, also at profit, so it left me with a smaller amount of shares, and then it came down here, and again, a loss of 0.84% because it closed below the 200-day moving average. Next day, could not get above the 200-day moving average, Thursday got above the 200-day moving average. I could have taken this trade again because of the close under, close back over. But what's happened here, it's starting to lose respect for the 200-day moving average. We closed above, we closed below. We closed above, we closed below. We closed above, we closed above, but it's starting to lose respect for the 200-day moving average. And when you start losing respect for a moving average, I tend to want to go lower and look for another moving average that has held and has had respect for that moving average. And you can see here's the 250 day moving average. This has held. We had a close under, close over. It has held, got close to testing here. So going forward, if we have another test rejection of the 250, that will be an interesting entry point for me on CNCE, excuse me. Okay, let's get to the weeklies. Well, these weekly trades have been massive, everyone, and very grateful for that. This is IWM. Again, weekly trades are taken on Fridays. So every weekly trade I take is taken on a Friday. I did take IWM here. See the orange line here? This is the 300-week moving average. It went down below intra-week, closed back above. So I position size, took the entry, placed my emergency stop. Where would my close have been? My exit, my stop. Right? It would have just simply been a close below the 300. So this gave me a very good risk to reward ratio. I didn't know we were going to have this big rally, but I'm grateful that we did. Again, as it moves up, I take partial profits, 10% of my position size, whatever I have remaining. If it moves the value of 0.45 above the previous bar's close. We did get to trailing stop level here 2 weeks later. Now, if I get a close below a previous bar's low, I will get out. Has not happened. Has not happened yet. So I am still, there have been no trailing stop actions at all in this trade. Next week, if we got a close below last week's low, of course, I would take off. And of course, if it keeps moving up, I continue to scale out of the position on strength. So this particular trade so far, it's been a monster. 11.18%. We are coming into the downward sloping 50-week moving average and 50 EMA. I'm not surprised that we stopped here, and the market may take a breather here because a lot of indexes and stocks are getting to their 50-day. But nonetheless, moving forward, if we move up to a 65 RSI level, then I will go into trailing stop mode using the 5 EMA, and if I get a close below the 5 EMA, I am out. Alternatively, if it keeps moving up and rejects the 70 RSI, I will then get out of half of whatever I have left remaining if it does reject the 70 RSI, and then if I get a close below a previous day's low after reaching the 70 RSI, then I will be completely out of the trade. Again, a lot of rules. I don't expect you to understand all these rules from this podcast. It's great if you do, but again, that's why I offer private one-on-one lessons to teach you all this stuff. So up 11.18% on this weekly trade. Fantastic. Microsoft, another weekly trade that I took at the close of the week on 11/4/22. Why take the trade? Bounce of the 200-day moving average. Right? Just like I did on UUP. Position size, place my emergency stop 2 ATRs below, my end of day stop where? Close below the 200, got to trailing stop level, which is 1.5 ATRs above my entry. We're at trailing stop, but certainly no close below a previous bar's low. So nothing to do other than continue to take partial profits, again, if it moves the value of 0.45 ATRs next week. So essentially what I'll do is I'll take this week's closing price, 255.02. I'll add the value now of the 0.45 is 7.42. So I'll take 255.02. I'll add 7.42. That will be my first profit target for next week. I'll take the first profit target, add the 0.45 again to it again. That'll be my second. I'll take the second, add the 0.45 to it again. That will be my third. And I'll just put those in the system, and I'll take 10% off at each of those levels if they get there. That's the offensive part of trading. And the defensive part now, that because I'm in trailing stop mode, just a close below the previous bar's low, I will get rid of half. So this particular trade has also been a monster. From entry to current price, up about 13.09%. GDX. Well, GDX. Remember we were talking about V1s, V2s? Well, we have return to value V1s, V2s, like the trade that I took on CarMax. And then we also have higher low V1s, V2s. Well, this is a V1. I believe on CarMax, it was a V2 that I showed you. Well, this is a V1. A V1 now only consists of two bars. Bar 1, bar 2. Bar 1 goes below bar 1's low by a quarter ATR, and then bar 2 closes above the close. That is my entry signal. And it's a higher low V1, which higher lows are always better than lower lows when it comes to anything, actually, whether it's moving averages, whether it's moving average crossovers, whether it's V1s, V2s. Higher lows are always better. Lower lows tend to bounce and fail. Higher lows tend to trend. Okay, so emergency position size, emergency stop. Where is my end of day stop? So on a V1 or a V2, you don't have the obvious moving average if you're taking a moving average trade. So again, halfway of the washout bar. The bar that I entered was the washout bar. It washed out bar 1. So if I get a close below halfway of that bar, that is my end of day stop. In addition to that, I like that we rejected the -1 ATR channel. So remember we were talking about the -1? It rejected it, triggered the V1 entry. MACD was green at the time. It came on a lot of volume. And then I play this trade out just like I would play any other trade out, right? Position size, emergency stop, end of day stop, trailing stop level. Well, I did get to trailing stop level the next week. Now I'm looking for a close below the previous bar's low. Well, never happened, but I did take off half of my position on Friday. Why? Well, do you see the 50 moving average here? Do you see how we got above it during the week and then closed back below it? It has rejected that. That's a rejection. So I did take half profits on GDX on Friday because of that, for a 16.58% gain. Just a monster. Now, I didn't sell it all because the best thing about selling half of your position, in my opinion, is that it's one of the few win-win situations in trading. Because if this does go crashing down next week, then I am really going to be glad that I sold half and locked in this big gain, right? However, if it continues to move up, then I'm glad that I still have half. So either way, if it goes up or down, I can be glad for one reason or the other, right? So that's why I talk a lot about selling half of positions. So again, higher low V1, emergency stop, end of day stop, halfway to the washout bar, got to trailing stop level. Trailing stop level has not hit because we have not had a close below a previous bar's low, but the rejection of the 50 SMA here is a bit of a warning sign. A lot of times if you go from under 30 up to under 30, over 30, up to the 50 RSI or the 50 SMA, that is oftentimes where you will at least get, it will stop going up and get some consolidation. So this was a big, massive gain. I didn't want to be greedy about it. And essentially what I'm doing, I'm just following my rules, right? And that is one of my rules. If I have a V1 or a V2 that's very far below the 50 and it actually gets there, enough is enough. That's a good place to take. So locked in 16.58%, but still half the position. Q's, another weekly trade. Well, here we go. This is a higher low close back above the 200-week moving average. In addition, a V2. See the V2? Bar 1, bar 2 goes below bar 1, bar 3 closes above bar 1's close. So confluence of signals. Higher low close above the 200. Remember, lower low closes above the 200. They work, but they can tend to fail. And they did. Close under. This came from a lower low. Close under, close over, and then it failed. Now, the close under, close over is the higher low close under, close over, which more likely to trend. And again, in addition, have a V2 signal here, a confluence combination signals together, always the best. So entered here at 285.71 on the week of 11/11, place my emergency stop. Where's my end of day stop, or end of week stop in this case? Well, end of week stop is just going to be a close below the 200-week moving average. Have not got to trailing stop level yet, so trailing stop level not activated. So just waiting. One of two things are going to happen. It's going to go up to the trailing stop level. Then I'm going to tighten up my stop with my rules, or it's going to close below the 200, in which case I will get out, or in the worst case scenario, it would close at my emergency stop. So this particular trade is up about 2.22%. TLT, a lot, over the past couple months, every trade I've talked about has been a deep dip buy. Well, because the market's been down, right? But it's nice that I've been able to kind of trade some other strategies, right? I trade 5 different strategies, but when the market's so low, then you're in deep dip buy mode. But here we have some other strategies as well, like the V1s and the V2s, the return to values, and I imagine in time we'll get some crossover trades as well, which is another strategy that I use. Okay, iShares, bonds. Well, why did I buy this? I bought this back here on 11/11. I had a intra-week under over 30 RSI. So this is a deep dip buy. Under 30, over 30, also had a V1. Bar 1, bar 2, bar 1 goes under bar 1, closes above bar 1's close, place my emergency stop. When I take an under 30, over 30, where is my end of day stop going to be? Well, I took the under 30, over 30, so therefore if it goes back under 30, I will just get out, right? But again, this is a higher low close. This went under 30, over 30, but it came at a higher location than the previous low, which just makes it better, as I've been saying. So I entered here at 97.90, position size, place my emergency stop, my end of day stop where, if I close under 30 RSI. Just came revving up, moving up. Of course, I always take partial profits on the way up, 10% if it moves the value of 0.45 ATRs from the previous bar's close. So I am definitely at trailing stop level, meaning if I get a close below a previous bar's low, I will get out. Now, the rules with an under 30, over 30, if I reject the 50, I would sell half. If I reject the 50 RSI, I would sell half. Right now, it's 48.31. So next week, if it does go above 50 at some point during the week and then close below 50, I'm out of half. That's just all there is to it. If it went all the way up to the 50 SMA, I don't expect that, but who knows? I would sell half. If it keeps moving up, I'm going to continue to take partial profits off. Or if it comes down and closes below a previous bar's low, then I'm going to sell half as well. So there's things to the upside where I could sell half. There's things to the downside where I could sell half. But nonetheless, this particular trade has been a monster. It has been a monster. And from entry to current price, up 8.5%. Amazing. Joe. All right. Coffee. Again, on the weekly bars. Why did I take this trade? Well, very similar to UUP on the daily that I took. I took it because it came down and bounced at the 200-week moving average. I position sized by taking my maximum allowed loss, dividing by the value of the 2 ATR. That shows me how many shares to buy. I place my emergency stop 2 ATRs below. My end of week stop on this trade, simply a close below the 200-week moving average. Of course, I place my trailing stop level 1.5 ATRs above. And so far, so good. Was much higher in the week. But currently, this particular trade from entry to current price up about 4.33%. And then finally, let's switch to some monthlies. Of course, when I take a monthly trade, that's going to happen on the end of the month, the last day of the month. So I took this all the way back on 10/31. Why did I take the trade? Combination of signals. Close under the 200-month moving average. Close over the 200-month moving average. Also a V1. And also a rejection of the negative third ATR channel. Now, a rejection of the negative third ATR channel, just by itself, I would not take a trade. But in addition to, in conjunction with the other valid signals that I have, it adds a little cherry on top, right? It adds a little more confluence of signals. So again, position sized, emergency stop, end of month stop, simply a close below the 200, have my trailing stop level up here, have not got to it yet. I have these lines here. Well, this was the profit target on these. This profit target, this profit target, this profit target. I have to adjust those. it did hit that first profit target the first month after, and so I did take off 10%. So I mitigated if it comes crashing down, taking off 10% at a profitable level, of course, helps mitigate the numbers when they come out in the wash. So anyway, this particular trade, not to trailing stop level, still holding its end of month stop, and this particular trade up 3.71%. All right, so I hope that was helpful. I hope that helped you be able to kind of see how I work off particular levels. And, I want to say right now, so many people have been surprised by this bottom. I've had so many people say, oh no, we're going to go much further down and so forth. I've been reading the news and I'm like, yeah, we all read the news and it's the news is always the worst near the bottoms. Peter Brandt just recently posted something on Twitter, says, oh, everyone's learning to short at the market bottom. And it's true. My advice would be to pay less attention to the media or what people are saying and predicting about what the market's going to do and just use the levels. I mean, these trades that I've had here on the weeklies have been outstanding. Some of the biggest trades that I've had for a while, and it wasn't rocket science. I just read the price action of, did it reject this moving average? It did. I position size correctly, set the emergency stop, end of day stop, all that stuff that I talk about and that I teach. And that's pretty much it, and have some massive returns on that. So everything that you hear on the news and what people are talking about, their predictions, they're just predictions. But the price action is the truth. If you're rejecting a moving average, it's telling you something, right? And so just my 2 cents on that. So, all right, before we start going down through potential trades for next week, let's do a little trader psychology. This is from one of my favorite Twitter channels, the Divergent Trader, Alan Edwards at Divergent Trader. Always succinct, but packs a lot of weight in what he says. A good day is not because of a big win. It helps, right? But really, it's true. A good day is not because of a big win. A good day is because you followed your plan. And by following your plan, it doesn't mean you're always going to make money in the short term. But if you're using good trading principles, good risk to rewards, position sizing correctly, rejections of moving averages or certain levels, in the long run, that's what will make you a profitable long-term trader, is the ability to follow your plan. And there are times when I follow my plan and it does cost me, but capital preservation is the most important part in trading. And if you're trading correctly with good trading principles, good risk to rewards, that if that's part of your plan, then that's what's going to get you the money in the long run. So a good day is not because of a big win, right? It's true. I mean, it's great when it happens, but that's not how you should view a good day. A good day is because you followed your plan. And if you're not following your plan correctly, maybe you're sitting down, creating it, it's good, it's perfect, but if you're not following it correctly, my guess is that your position size is too high and it's amplifying your emotions. There's a fine line between having a decent enough position size where it makes a positive difference if you're correct, but it also can create a negative difference in your results if your position size is too high and the emotions get amplified and it gets you out of your trade or gets you out of your process. That's why 1% of your total trading capital divided by the value of the 2 ATR, in my experience, is the perfect balance of all that. So please follow at Trader Divergent over on Twitter and follow his posts because they mean a lot and it's great information. Okay, before one last thing, let's take a quick look at a market poem. This is from Frank at Franco D over on Twitter. Good friend of mine, great trader, great poet. great musician, great journalist. Really look up to Frank, and I love his poems. Let's see what he has to say today. A good trade is the one that's thought through. It's the one that combs a chart for every clue. It measures the risk that is right for you. It sets up a springboard for gains we pursue. Kind of similar to what I was just talking about, and talking about trader divergence as well, right? A good trade is one that's thought through. It's the one that combs a chart for every clue. What does that mean? Good risk reward ratio. Where's your stops? Um, are there confluences, combinations of indicators lining up together? That's what it's the one that combs a chart for every clue means. It measures the risk that's right for you. Again, back to risk to reward. It's a setup springboard for the gains we pursue. Isn't that great? Please follow Frank at FrankOD over on Twitter, and he does post a poem every day. All right. Okay, so let's start out with potential long trades that I'm considering for next week. Not a lot of them because we've had this rally, but I've gone down through here and I've identified some things that I like. Amazon. Okay, well, Amazon did have a V2 back here. Do you see, again, we were talking, V2 consists of 3 bars, bar 1, bar 2, and bar 3. Bar 1, bar 2 goes below bar 1, bar 3 closes above bar 1's close. Of course, you position size, emergency stop, end of day stops, a close below halfway, the washout bar. Now, I did not take this trade. It is valid. It's a higher low V2, but I did not take this trade because it seemed a little stretchy, a little chasey. It seemed like the risk to reward ratio wasn't so great. And in hindsight, that was the correct move because it has gone down since then. However, if I had taken this trade, I would have a close below halfway. This washout bar here would have been my end of day stop. Well, this V2 is still technically in place. It has not closed below this halfway bar. So I could go in here, I could have bought this on Friday here. All I would have done is gotten a better risk to reward ratio than when I would have taken the first kind of legitimate trade, but I deferred because it seemed a little extended. So what I'm looking for next week on Amazon is if we move down and test halfway of this washout bar and then recover, then that gives me an excellent risk to reward ratio with the V2 still being valid. Does that make sense? So next week, if we come down, test that halfway, either bounce at it or go underneath it and then close back over, that will be my entry. And again, if it closes below that, then that's my exit. So, this is a little ethereal, I would say, probably not the right word, a little unorthodox, but it remains the same because this V2 is valid. It's remaining in place. I'm just looking for a better risk to reward ratio, and I would love to see it just test it again, close back over, then I could go in and buy it, and my stop would simply be a close below. So hope that makes sense. You usually don't hear me talk about trades in that sense, but I do like that this V2 triggered because it's a higher low V2. Just thought it was a little chasey, and that turned out to be true. So again, one last time, just waiting next week if we can bounce or reject the halfway of that bar that happened on the 29th, I will enter and then just simply use a close below that as my exit. Concert Pharmaceuticals. Well, we just talked about Concert. Had a trade on it. I'm not really looking for a close over the 200-day moving average. I mentioned before, we've closed under, we've closed over, we've closed under, we've closed under, we've closed under. It's kind of lost respect for this 200. What I would be looking for, it has respect for the 250. So next week, really what I'm looking for is a continuation down, rejection of the 250 SMA, or a rejection of the 300. 300. That's what I'd be looking for. And if we do get down here and test this previous low, we will have a double bottom with a bullish divergence, something I learned from studying with Dr. Alexander Elder. Really like double bottoms, bullish divergence. They don't happen a lot, but if we could get down here and test this previous low, we would have a double bottom bullish divergence, and we would also be at the negative 300 level, or negative 300, the 300 SMA level, and that is a level that I would be interested in. But again, a rejection of the 250, I would like that, or a rejection of the 300, I would like that, especially because it comes in combination with a double bottom bullish divergence. And again, these are all the things that I teach in my one-on-one lessons, and I will give you more details on that as we get closer to the end of the podcast. So that's what I'm looking for on CNCE, rejection of the 250 or rejection of the 300 next week. Lift. Okay. Well, lift, if you look at this, I am looking for a V2. I'm looking for a V2, but a V2 consists of 3 bars. Currently, we only have 2, but we have the makings of a V1. We have bar 1, we have bar 2. Bar 2 goes below bar 1, washes it out. Next week, Monday. It would have to be Monday. It has to be the very next day. If Monday we can close above bar 1's close of 1120, then that will give me a V2, and it's also a higher low V2, and MACD has just turned positive, right? The green line has just turned over over the red line. So that's a confluence of indicators. What are they again? If we get a V2, or in other words, Monday, if we get a close above 1120, that will be a V2. It's a higher low V2. It's a rejection of the negative 1 ATR channel. And MACD has also turned positive and would give me a very good risk to reward ratio. So again, next week on Monday only, I will be entering lift if it closes above 1120. Now, if it closes way up here, if there's some reason we have a big monster day on Monday with a close up here, I would not take that. It has to give me a good risk to reward ratio as well. And that's kind of subjective. Would I buy it to here? Maybe, excuse me. Would I buy it to about, I'd probably buy it to about here. If it closes up here, it's too far gone. And I may take the same strategy as I did with Amazon. And if it's too chasey, waiting for a little bit of a pullback to give me a better risk to reward ratio. But on Monday, potential higher low V2 with rejection of the negative 1 ATR channel and MACD crossover as well. PayPal. Well, PayPal has not really participated like the rest of the market here. But what am I looking for on PayPal? If we get a under 30, over 30 on PayPal, that will be my entry. Don't know if we'll get it, but we're within striking distance of 35.17. So what I'd love to see is a combination of an under 30, over 30 that dovetails nicely with this negative third ATR channel. 92% of prices when it gets to the negative third ATR channel tend to bounce. I mean, we can look, got to the negative third here, bounced, got to the negative third here, bounced. So just waiting for a move to the negative third ATR channel, just because it does that, I'm not going to take it, but it would strengthen my case for the trade if we did get near the negative third ATR channel and in addition had an under 30, over 30. So that's what I'm looking for next week on PayPal, is under 30, over 30 that happens here near the negative third ATR channel. VIX. VIX is very interesting here to me, folks. I think we have made, I believe I read a 16-year low on the VIX. And what is VIX? Well, VIX is volatility, and volatility, really the math behind the VIX is that it takes into account the increased price of a put on the S&P 500. So if the S&P 500, if puts get more expensive, then generally the VIX rises. VIX is volatility. And I know that a couple times in the past I've talked about VIX, and when it was super low, and I said, well, the market apparently is pricing in that there will never be any more volatility left in the world. Well, we know that's not true, right? When there's no volatility, that leads to volatility. When things are volatile, that leads back to non-volatility, whether it's in trading or in our life. right? In our life, things go along, no volatility, things are just easy peasy, and then something happens and there's volatility. Well, that's part of nature. Volatility leads to less volatility. Less volatility leads to more volatility. And here we are on the VIX. I mean, look at this absolute sell off in the VIX. Again, the market's pricing in that there's never going to be any more volatility. Well, there is. I promise you. I don't know when, but it will happen eventually, and VIX will go up. And if you know anything about the VIX can do this for a long time and then shoot up. You know, there's a lot of things going on politically around the world, inflation, all sorts of stuff. This is very actually confusing to me, but it is what it is. So I'm waiting for some kind of signal. Well, what signal could I potentially have? Well, just as simply under 30 over 30. Look, we're at 25.91 right now. If we, for instance, on Monday, we could get a V2, because here's bar one, bar two goes below bar one. Monday, we could have a close above bar one's close. That would give us a V2 and an under 30 over 30 and an under the negative third over the negative third. So I'm not trying to predict this, but this is extremely low. And I know big picture there will be volatility. And let's see here. Yep. And the other interesting thing is we have a lot of volume in these last three bars, a lot. Now, why does that matter? Well, usually at tops and bottoms, you get a lot of shares of things changing hands. And just to me, from my experience, seeing this huge volume at this kind of ridiculous low levels is indicating that we're getting close to a bottom. Not predicting it, just from experience. But again, I need to use an actual signal, just not my prediction or theory or outlook or bias on this, but an under 30 over 30 would get me long the VIX. Okay, so that is it for the potentials on the daily. Now let's look for some long potentials on daily. Let's look for long potentials on weekly. And here we go. Again, weekly bars, these trades would be taken on Friday. Okay, Apple. Well, Apple almost triggered a V1 this week. Bar 1, bar 2. Bar 2 goes below bar 1, but does it close above bar 1's close? Well, the close was 148.11, and we closed at 147.81. So you can see we did not create a V1. Almost kind of a failed V1. But if a failed V1 doesn't happen, you can also enter the trade with a V2. And so next week, if we close above bar 1's close at 148.11, then that will be a V2 entry that I would be interested in based upon how far next week's close, if it does close higher, closes. If it closes way up here, then the risk to reward's not so hot tamale, right? But if it next week we kind of maybe close in this area, a nice confluence or a nice closing would be a close over the 20 EMA, and then that would be a V2. So bar 1, bar 2 goes below bar 1, does not close above bar 1's close. Next week, however, if it does close above bar 1's close, but not too high, then that's a higher low V2. See, here's a low. You can see this low is higher than that. And just like on GDX, on that monster trade, it's the same setup. Makes sense? So next week, if we close above 148 and probably not much higher than 150, I will take the trade, the long trade on Apple with this higher low V1, V2, potential V2. AMD. Well, AMD had a close over the 200, which is nice, but it did come from a lower low. What I'd really like to see on AMD is it come down. It'll probably come down. If it does come down, it'll probably hold halfway of this bar here and then close back up higher. So I'd like to see it close under and then the next week close over, or next week essentially just going under and then closing back over. That would give me a higher low V2 entry. I do want to get into AMD, but I just don't want to chase it here because it came from a lower low. So if we came down kind of substantially and then came back up and closed back above, then with a good risk reward ratio, that would get me interested in AMD. Tesla, well, shucks. Tesla had a big move. I guess I was too patient. I was waiting for it to come down. I highlighted this green box here, which would be a really good confluence of entries. And last week I didn't take it. I actually wanted to see it test the 200 before I got interested, and that cost me. So sometimes your rules are going to cost you because it did bounce and it bounced hard. But again, I'm not going to chase it here, but I really like the confluence of this negative third ATR channel in addition to the 200-week moving average. So I'm just going to be patient here, wait for the stock to come to my level instead of chasing. Next week, if we get a bounce off this 200-week moving average or an intra-week rejection or alternatively a close under, close over next week, that's where I'm going to be interested in buying Tesla. But that one got a little away from me. I was a little too patient, but that's how it goes. But waiting for some kind of rejection next week of the 200-week moving average. VIX, we talked about VIX again. We talked about it. We just talked about it on the daily. Also, would be interested in taking the trade on the weekly. We're at 27.25 next week. If we close above the 30 RSI on a weekly close on the VIX, that would be my entry point. We are here at the negative third ATR channel. Remember, 92% of prices tend to bounce there. But I'm not going to take it just because it's there. I want to see it close back above 30 RSI as my entry point. All right, so those are the potential longs for next week. Let's also talk about some potential shorts on the daily. Gold. All right, well, this could have been so high. I'm trying to get the charts so we can see them. I could have shorted gold on Friday because we had a close over the 200 and a close under the 200. But it comes from a higher low perspective. What I'd like to see is it to go above the 200, but maybe not above this high and then close back below. I thought we were going to get an island reversal or abandoned baby pattern, which is very, very, very strong. That consists of 3 bars where you have a gap to the left of it, and then you have a gap back down to the right of it. The very, very strong signal, but it did not happen because it did close above this low. But I'm starting to think here that the metals at these levels are getting a little extended, and so I am looking for a short. In addition to that, look, we have a double top and a bearish divergence. Here's our high with very, very strong momentum. Then we have a pullback into some red bars. Now we are higher than these bars over here. Do you see how we're higher here than we were here? But look at the MACD. The MACD is much lower here than it was here. What does that mean? It means that the momentum on the way up here compared to this move is waning. And the implication from that is that we're probably running out of buyers. And another implication of that is we're probably moving back down. So I am looking to short gold next week. I'd like to see one more move up above the 200 and then a move back down below. So another test above, test the waters. If it fails, that would give me the confidence to go short on gold. Russell. Well, we just talked about double tops, bearish divergences. Here we have another one. Here's a high on Russell. You can measure the MACD bars, the height of the MACD bars. Then we pull back into some red. Now, almost as high, but you see how the MACD bars are not as high? Again, that losing momentum. So I'm not going to short just based upon that, but what am I going to short on? Well, I'm going to short off of this 250-week day moving average. Right here about 190, so a couple points higher. So if we go above the 250, either intraday and close below, or we close above and then close below, that will be my short entry on IWM. And you might say, Greg, how are you going to do that? Because you are long IWM. It's true. always makes it a little bit tricky. But I'm long on the weekly, not long on the daily. So how would I express my trade if that happens? Well, I'm going to keep my IWM weeklies just as long as my process and plan and rules tell me to. But if we do reject this 250-week moving average next week, I'll probably just express it by buying a put on IWM. But again, in a nutshell, if I get a rejection of the 250-day moving average, I will short this, especially in light that we have a double top bearish divergence here. My opinion, I certainly could be wrong, but I am starting to get a little bearish. We've had a substantial move here. Yes, we're in the December month in December, which is generally seasonally positive, but this has been a big move, and I'm starting to see momentum waning here. We're getting to certain levels here that I think is pretty significant resistance. So again, for me, IWM, rejection of the 250-day moving average, I will buy a put and express my short position that way. Southwest Airlines. Again, double top, bearish divergence on the MACD. We also have a RSI divergence, meaning look at this high. Look how high the RSI was here. Look at this high, higher now. RSI was less high. So we have a RSI divergence. We have a MACD divergence. We're getting close to the third ATR channel. We held above the 200-day moving average, but next week on the daily, if I have a close back below the 200-day moving average, I will go ahead, short Southwest Airlines. Position size, emergency stop will just be a close, or emergency stop 2 ATRs below, and a day stop will just be a close above the 200, just like on the silver trade. Microsoft. Again, I am long Microsoft. So what is the guy to do? Well, I am looking to short with a rejection of this downward sloping 200-day moving average. And I am long the stock, and so the same with the Russell. If next week we do get up to this 200-day moving average and reject it, I will express my trade by buying a put. We're coming into an order block over here. This is ICT Mentoring. You can look him up on YouTube, ICT. But here we have this high, and then we break this low here, which breaks the market structure to the downside. We also have a fair value gap between here and here. We are right in the middle of that gap. We are also getting close to the bottom of that order block. And so right in this area, I think this is about it. But that's just my own bias, right? But I have to wait for the price action to really tell me that we are that it's rejected a level that's important to me. So yes, next week, if we reject the 200-week moving average to the upside, I will get short Microsoft. SPY. Okay, so we are at a very crucial level on SPY. I'm going to show you this on the weekly. Maybe it shows you a little bit easier. But look at the trend line. This is a trend line that people have been looking for. The whole market knows about this. Trend line, you connect the tops, 1, 2, 3, 4. Every time we got to that trend, we failed. We got to the trend, we failed. Where are we now? Well, we're right there, almost to the penny. You see how we moved right up into that trend line and failed? So that's another reason I'm a little bearish on the market. We could push through this. We could squeeze the shorts like crazy. But big picture here on the weekly SPY chart, if we pull back from this, I think we're going to be going down a little bit. So with that said, another option for me to get short on something next week would be the daily on the SPY. It is above the 200, right? But you see how the day on Thursday we literally rejected that trend line almost to the penny and came back down. I would not be surprised if we would test that trend line again and then come back down. I would get short SPY then. Of course, where would my stop be? Just be close back over the trend line. that's it. I place my emergency stop and so forth. So I think you can probably tell, I think we are running into some pretty significant resistance levels, both with trend lines, moving averages, RSIs, double tops, bearish divergences. So yeah, I am getting a little bearish on the market at this point. But again, still have to use my signals, not my bias, to tell me to get in. All right, those are the daily shorts. And then last but not least, let's get to the weekly. Where are my weekly? Oh, here we go. Oof. Weekly shorts. Oh, no. No. Don't have any weekly shorts. Sorry. Mistake. That's it. I do not have any weekly shorts. So, I mentioned at the beginning of the podcast that I do teach private one-on-one lessons in the evening time via Skype. When I teach, there are 5 sessions, and each session consists of 3 hours. So it gives you 15 total hours of instruction one-on-one with me. I really, honestly, sincerely believe that the best way to learn anything is to learn it one-on-one with your instructor or your coach, and that's why I offer these in this format. I ask you a lot of questions during the course. You can ask me any questions, but it's a difficult course. I'm not going to lie. There's a lot of content, but if you really want to learn how to become a trader, if this is something that you really want to do, taking my course is going to help you. I promise you. I have taught so many people from around the world, and I know they've been happy with the results of what they're doing. The price of the course is $1,750, but it is worth every single penny. I promise you. And so if you're interested, my email is in the link of the description. Just send me an email. Say, Greg, interested in your course. I'll reply and say, great. Let's set up a Skype call. The Skype call is free. It's not a sales call. I promise you. I have a lot of students. Don't need to try to sell you, but why I like to have that free Skype call is just to get to know you a little bit better, learn about your expectations of trading, learn about your trading challenges and your goals, and then it's a great time for you to ask me any questions about the course. So if you are interested, just reach out to me. Again, emails in the link of this YouTube video, and we'll have a Skype call, get to know each other. You can ask me questions, and then when we're done with the call, I will not pursue it. You have to contact me, and if you want to take it, then just email me back and say, Greg, I'm ready to go. But I promise you it's worth every penny, and you will learn a lot, and you'll learn all 5 of my trading approaches step by step. Another thing, if you like online courses, I do have a great online course available at udemy.com. The link is also in the description of this video. You can see from the trades that I've shown you this week, they were almost all of them were deep dip buy signals, and they were very profitable. That's a great course. It only costs between $12 and $15 on Udemy, but don't let the price confuse you or make you think it's not worth a lot, because it is, because there's 9.5 hours of video. There's 26 videos total, 15 study guides, and I teach you step by step how to trade the deep dip buy stock trading strategy. So the link's in the description. Third thing, if you like today's podcast, if you found it valuable, I would really appreciate it if you could just hit the thumbs up button and or share it with people on social media. Get the word out. If the more people hit the like button, the more that YouTube says, oh, there may be some valuable content here, and their algorithm helps them to get out and share it more. And there are a lot of people that could use some help by using good trading principles in trading. And if you hit the thumbs up button, it helps to bring them in, and it also will help them. So help me by helping them by hitting the thumbs up button. And then lastly, and most importantly always, please try to go out and do something nice for somebody today. I'm a big animal lover. If you could also go out and do something nice for an animal, I would really appreciate that. One day, you may need it. Somebody will be there for you, or an animal will be there for you. That's certainly possible, but I just think it's good karma, and it would make the world a better place if we could just go out, do one nice thing for another human being today, and one nice thing for an animal. It's good for you, it's good for them, and like I said, it's good karma, and it would make the world a better place. So I appreciate you watching this today. I hope you found it helpful. I hope you have a good weekend. Get out there, maybe do a little exercise, take a break, do a little chart study, do a little deep breathing, just some healthy things. But hope you had a good trading week last week. Hope you have a good trading week this week. Remember, position size, follow your plan, have a good risk to reward ratio, and that's pretty much the best advice I can give you. So thanks again, everyone. God willing, see you next week. And on the way out here, I have to run the U.S. legal disclaimer. So thanks so much. Take care. We'll chat soon. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.